Good morning. It's Jeffrey Christian of CPM Group. It's about 11:50 in the morning on Tuesday, the 14th of March. Originally, when I thought about what we would talk about today, it would be bank failures. The Silicon Valley Bank failure last week, and the follow-up in the markets and with monetary authorities and bank regulators since that time. CPI was coming out today, so we decided that we would talk about CPI and inflation, where we are with that, as well as the bank failures, and then the implications for gold and silver. So a little bit of ground to cover. Now, what does SVB's failure mean for the economy, gold, and silver? In and of itself, very little. Silicon Valley Bank was, I guess, about the 16th largest bank in the United States. It had a couple $100 billion in assets. It was what one of the economists at Morgan Stanley termed an idiosyncratic bank. Other people have said it as a poorly managed bank, but let's stay with the idiosyncratic aspect of it. It had focused a lot of its activity on a very volatile and tenuous industry, technology, and it had not developed a diversified bank set of clientele. It probably had been doing some other things too, and it got into problems that way. And let's be honest, the problems were really triggered in many ways by a tweet by a person whom personally I would never work with, and have said I would not work with, and am always hesitant to work with people who work with him, which was perhaps a little bit irresponsible on him, but hey, irresponsibility is one of the clarion calls of America today. So it probably doesn't spell problems for the broader economy. And it probably represents a short-term blip, both in terms of the economy, financial markets, gold, and silver. Doesn't necessarily trigger or signal the start of the next recession. It is a sign of things to come, and it is a sign of fragility. And as I'll say in the next slide, we have to pay attention to market sentiments because sometimes they're more important than realities. People often ask CPM Group, what will cause or start the next recession? And our answer is recessions tend not to be started by a single development. You always have the cause and the occasion. The causes are the underlying factors that make something happen, and the occasion is the trigger of something. It's usually a combination of developments that cause a recession to occur. And it probably will be again this time. It'll be supply constraints in the real economy, not supply chain constraints, but supply constraints in a real economy that's been expanding long enough and is bouncing into those supply constraints, both for goods and for services. And as you may have noticed, we have a tremendous amount of slack in both goods and services in the economy currently. Another factor will be cooling demand from consumers and from business and from government, demand for goods and services. And we haven't really seen too much cooling. We've seen cooling in the housing market because its pricing got grossly overheated by a wave of institutional investors speculating and buying up properties, competing with actual would-be real homeowners, and sort of the destruction of the American dream of owning your own home by these institutional investors. But aside from that and a couple other sectors, you still see pretty strong demand from consumers and from businesses, both for investment and development. Fiscal reductions. We have seen a very large decline in fiscal stimuli and fiscal excessive spending by the U.S. and other governments, but it's still very, very high by historical standards. There's talk about further reductions and further movements to reduce the deficit spending on the part of the U.S. government, states, and local governments, But right now, it's just talk, as it has been for the last 50 years. It isn't really there yet. So wake me when the government becomes responsible. And then international and national political tensions can actually exacerbate it. Now, oftentimes, the trigger does occur in the financial markets. A debt crisis, and we always say, we will look for a debt crisis to emerge in some obscure corner of the debt market. In the past, 1991 recession, it was the savings and loans commercial real estate crisis, where they had lent at overpriced values for commercial real estate. In 2001, it was the internet bubble bursting. In 2006, 7, 8, 9, it was collateralized mortgage obligations. This time, we're not quite sure it is. Now, SVB was a pretty obscure corner of the debt market. But is it the trigger of a recession? We don't think so, because those other ingredients aren't there. We think that you have to see more constraints on supply in the real economy, cooling demand for goods and services in the real economy, real fiscal reductions, even more so than what we've seen coming out of the pandemic and the lockdown, and worsening international and national political issues, such as we expect to see possibly as early as the fourth quarter of this year, or maybe next year. So we don't necessarily see this as a major beginning of the next recession. It is a sign of things to come. I also wanted to talk about inflation. February CPI was released this morning. On a month-to-month basis, it was 0.4, down from 0.5 in January. January was very strong. There was a tremendous amount of demand. If you look at what we're seeing in terms of the pockets of inflationary pressures, food, still a big problem. Electricity, fuel oil for heating, and natural gas for heating. Medical goods and services, and transportation services. Those were all high. Shelter was also pretty high. Other factors were down. Used cars, which were one of the harbingers of inflation in 2021, were off like 13 or 14%. So we are continuing to see lower inflationary pressures on a month-to-month basis. And that's being reflected in a year-over-year inflation. The blue line is the headline inflation, which includes food and energy. It's been coming down for, 8 months now? And the, whatever color that is, purple line, is less food and energy, so it's core inflation. And it's been coming down for about 5 months now. So we are starting to see a continuation of the not deflationary, but disinflationary pressures. This is the longer-term view of CPI, and you can see the big spike up in 2021 into 2022, and then since the middle of 2022, it's starting to decompress, similar to other spikes in inflation back in the 40s and 50s and 70s into 1982. So that's inflation. Now, a little bit more on interest rates. The Fed will be meeting next week on the 22nd. Watch what the Fed does and says. Market expectations have been flopping back and forth very volatilely over the last the first 2.5 months of this year. Market expectations are often wishful thinking, or guesses, or mere extrapolations of what we've seen most recently. So in January, the market expectations keep getting it wrong. In January, the market consensus was that the Fed would have to loosen sooner than the Fed was saying it was planning to, and it didn't. The Fed stayed on track, and by February, you saw people say, no, the Fed has to be tighter than it says that it will be, and they were wrong. And now, after SVB, they flipped back and they know the Fed will have to be much more accommodative than it says it will be. Oh, it cannot possibly raise interest rates on the 22nd of March at the FOMC meeting, and it may actually have to lower it. I don't believe that. I wouldn't be surprised. I think our view is that we might see a 25 basis point increase in March, and again another 25 basis points at the May FOMC meeting. Pretty much what the Fed has been saying. Pay attention to what the Fed says and does, because actually the Fed seems to have it much more clearer than the market consensus. Now, that said, as I said earlier, sometimes sentiment means a lot more to the short-term valuations of assets than reality. So you have to pay some attention to those market sentiments because they can drive the prices of gold and silver very high, and then they can take them back down. An example of where the Fed got it right and the market was just dead wrong, 1987 when the stock market burst. And the market said, the Fed has got to lower interest rates. And the Fed said, no, the stock market fell because of stock market reasons. The economy is healthy, it's strong, we're not going into a recession, so we don't need to cut interest rates at this point. And the Fed was right, and the market sentiment was wrong. And that's not the only time, it's just one of the more prominent ones. Also, as we've said repeatedly, it's not just monetary policy, and it's not mostly monetary policy. What is occurring in the real economy, that's supply and demand constraints, and fiscal policy, those are more important than monetary policy. The monetary policy accommodates economic and fiscal policy, economic realities and fiscal policy. So what's all this mean for gold and silver? Well, pretty much as we've been saying, there is a short-term part that we haven't been saying because the SVB thing only emerged last week. We expect the prices to decompress from the overheated fear of the past few days. We saw gold prices rise very sharply from like 1840 to 1900 to 19 something and back down to about 1900 today. Silver shot up. It's back down to about 22. We think that prices will further decompress over the next few days as the markets realize that SVB is a, quote, idiosyncratic situation, and it does not spell problems. And quite frankly, by today, Tuesday, we're already starting to see the markets shift back to that more reasoned approach and view and opinion of what's going on. We continue to think that the prices will consolidate over the next 6 months or so. What does that mean? That means prices may trade in a range, probably higher than the range last year, and probably lower on the high end side. So maybe 1730, 1750 on the low, and maybe 19 or 90 or 1980 on the high side. For gold, silver, $20 to $28. And then at some point, prices we do expect will move higher when the economic, the financial, and the political factors grow much more serious. That could start to emerge in the fourth quarter of 2023 or 2024. Politics will have a lot to do with it, and politics start getting serious in the final 5 months of 2023 in terms of political, presidential, and also congressional elections in 2024. People who have underestimated the government's abilities to keep things hanging together have consistently lost money or not made money that they could have. People who think in black and white terms instead of shades of gray miss the nuances that are critical for asset valuation. When you hear somebody saying, SVB, a bank that no one had heard of until last week, has gone under because it focused all of its attention on spurious companies in the technology field. That's going to trigger everything, and we're going to see the collapse of the dollar, the collapse of the treasury, the collapse of the U.S. economy. It's just going to be consistently wrong. Look at how many financial crises and how many economic downturns the United States and the global economy have experienced and survived. Now, I don't want to sound like I am condescending to people who have extreme views that are consistently wrong, but I guess I am. Our marketing people have put together this beautiful thing. We will be launching our gold market, our gold yearbook on March 28th. There will be an online briefing. We will have a link for that soon. You may pre-order the report, as some people already are doing, at our website at this link. And in addition to that, we will have an open forum for our clients, including our retail investor program clients, on Monday, April 3rd at 11 a.m. Eastern Daylight Time. The gold briefing on March 28th will be 10 a.m. Eastern Daylight Time. The open forum will be at 11 a.m. on April 3rd, on a Monday, April 3rd. And hopefully in the notes of this video, there will be a link where clients can send in questions for people to ask us to address in the open forum. The open forum, as we have them, is available for our clients, and we have no presentation. We might have some opening remarks just to get things open, but it's really just a place for our clients to ask us questions and have us address issues orally as opposed to in writing. I think that's all we have for now. You can go to our website and read other things that we've done that are free, and you can send queries about our services to info@cpmgroup.com. Take care of yourselves and those around you, and look for ways to help the world move forward and not collapse. I'll talk to you later in the week.